My name's Kyra Bell-Pasht, and I'm the Director of Research and Policy at Investors for Paris Compliance. We're a climate shareholder advocacy group founded in 2021 to fill a gap in the Canadian market, assessing the net zero commitments, plans, and actions of the country's largest fossil fuel financiers. Since then, we've assessed our major banks, insurers, and asset managers, benchmarking them against global standards, real-world financing practices, and their peers, work that has made headlines across national media. We've engaged directly with these institutions, met with CSOs and CEOs. Where strategic, we've filed shareholder resolutions. Tens of billions in shareholder value have broken with management to vote alongside us. All of this with the aim of pushing the market to adopt meaningful climate risk management practices. And yet, Canada's oil and gas producers, among the world's most carbon intensive, with plans to ramp up production, continue to receive increasing levels of financing and facilitation. That's why this past year, we shifted focus. We turned to the financial statements of Canada's largest oil sand producers. Our theory that Canadian fossil fuel financing persists not only because of record profits, but also because balance sheets and projections look strong on paper. We suspected that the environmental destruction of their operations, which will need to be remediated, and the looming risk of stranded assets weren't being fully accounted for in financial disclosures. If that's true, then the auditors tasked with ensuring accurate financial reporting may also be part of the problem. To explain how we tested this hypothesis, I'll hand it over to Jessica, our campaign lead.
My name is Jessica Carradine. I'm a senior analyst with Investors for Paris Compliance, leading our organization's climate accounting project. As Kyra said, our objective is for the financial statements to better reflect climate risk, which will ultimately help ensure that climate risk is being priced into the economy. To achieve this objective, we applied an established framework developed by UK-based think tank Carbon Tracker. Carbon Tracker developed the Climate Accounting and Audit Assessment Framework for Climate Action 100+, an investor network representing $68 trillion in assets under management. The framework evaluates whether companies' accounting practices and associated auditors' reports reflect material climate risk. We built on this framework to undertake more detailed assessments of Canada's two largest oil sands producers, Suncor and CNRL, and their financial auditors, KPMG and PricewaterhouseCoopers. We also incorporated an analysis of their decommissioning liabilities due to industry-wide issues with underreporting. We reviewed Suncor and CNRL's 2024 financials, specifically looking for whether and how material climate-related matters were addressed in relation to financial indicators, such as asset useful lives, cash flow projections, reserve estimates, and decommissioning liabilities. We reviewed the balance sheet, the notes to the financial statements, the auditor's reports, and we compared what we found against relevant accounting standards. The IFRS, for example, specifically says companies must consider climate-related matters when they are material in the context of the financial statements. We also compared against guidance published by the audit firms themselves regarding climate risk, financial reporting by other oil and gas companies with better disclosure practices, and audits conducted by the same firms, KPMG and PwC, for other oil and gas companies where the audit did consider climate risk. We used a common sense approach for this analysis, having experts and peers review our work. So to summarize our findings, for both companies, we found significant gaps in their reporting of the financial impacts of climate-related matters. Specifically, they did not clarify whether previously stated emissions reductions targets are reflected in capital expenditures, whereas we see other oil and gas companies providing investors with detail on how they are investing in the energy transition, such as through increasing renewable energy investments. They also did not clarify whether the energy transition may decrease the useful lives and the cash flow projections of oil and gas production assets, and in turn bring forward the timing of their decommissioning liabilities. Furthermore, both companies removed all mentions of their net zero Scope 1 and 2 commitments from their financial statements, which creates uncertainty for investors. Finally, both companies just failed to provide material information related to decommissioning liabilities. In spite of this lack of disclosure, the auditors, KPMG and PwC, stated that Suncor and CNRL's financial statements met accounting standards. The auditors did not provide detail on whether, how, or to what extent they considered material climate-related matters in the audits, and they did not address the uncertainty created by the companies removing all mention of their climate targets. In comparison, we see KPMG and PwC addressing these same issues in their audits of European oil and gas company financials, namely at Total Energies, OMV, and Enispa. So what does this all mean? Investors should be able to trust that companies and their auditors are ensuring that financial statements are accurate. That is the whole point of a financial audit. And yet it appears that climate risk is not being priced in, likely because companies want to report their financials in the best possible light. That's why it's so important that auditors and financial regulators demand transparency. Otherwise, the stability of the entire financial system is at risk. The IASB is aware there is a problem. It will be publishing illustrative examples this year to provide further guidance on reporting material climate-related information. So going forward, we should see companies and their auditors improving disclosure of climate-related financial risks. Otherwise, financial regulators will need to start cracking down.
Thanks, Jessica. So, what came of our first year working on this campaign? Auditors and the target companies, Suncor and CNRL, were unsurprisingly unwilling to engage with us on specifics related to our critique. Investors who have a clear interest in improved transparency were more interested in engaging with us and in the issue more broadly. We raised our concerns in the question periods at Suncor and CNRL's AGMs. We also reached out to the Canadian Public Company Audit Regulator, the CPAB, after the concerns we raised were not adequately addressed. CPAB has committed to look into the matter further. In the coming year, we will continue to assess whether climate and decommissioning risks are being accounted for by the sector. Our goal is to expand and deepen this analysis as expectations and standards evolve. We will work to strengthen investor pressure for more consistent, transparent, and forward-looking accounting practices. Where we see the accounting profession falling behind, we will call on regulators to act. We welcome partnerships with others committed to aligning financial reporting with the realities of climate risk. Ultimately, our hope is that financial statements fully reflect the environmental liabilities and climate transition risks facing oil and gas producers, not just in Canada, but globally. Because when accounting reflects all financial risks, markets can make informed decisions, and capital can flow toward a truly net zero economy. For more information, please visit us at www.investorsforparis.com. Thank you so much for your time.